I want you to look at the chart on your screen right now, but don't just look at the price. Look at the line, that massive vertical line sticking up from the top of the candle like a jagged needle. That is not just a line. That is a crime scene where the price of silver flashed to $83.71 before collapsing back down to $74.47. This $9 swing in a single trading session was not a random fluctuation. It was a calculated algorithmic attack known as a stop hunt, designed specifically to wipe out leveraged traders who chased the gap on a Sunday night. We are currently in Ghost Week, a period where liquidity dries up and the order book is empty, allowing banks to let the price run up to suck in retail money before slamming the door shut. If you are a new investor, this drop probably terrified you, making you think the bubble has burst. But veterans of 1980 and 2011 recognize this as a rinse of the leverage. The banks have a database and know exactly where retail traders put their stop-loss orders, mostly at the $75 level, so they engineered a drop to hit that zone, triggering a waterfall of thousands of sell orders that allowed the banks to buy back those same positions at a massive discount. Technically, the candle forming on the daily chart is a shooting star, characterized by a small body and a very long upper wick that represents a rejection of higher prices. While this typically signals a pause or buyer exhaustion, it is vital to look at the closing price relative to Friday. Despite the crash from the highs, we are still up nearly 10% from last week's close. The trend remains firmly up, and the breakout is valid, but the easy money phase has shifted into a volatile grind. If we look to gold, it is trading at $4,514, sitting calmly at all-time highs, while silver acts like a high beta sibling overshooting in both directions. Gold is the anchor of the monetary system, and as long as it holds the $4,500 level, the floor under silver remains secure. This volatility is simply the price of admission for silver gains, and today's $9 fall was made possible by air pockets in a hollow order book. Interestingly, the price bounced at $74.47 because $75 was the old resistance level from last week, and in a healthy market, old resistance becomes new support. While retail dumb money was buying the strength at $83, smart money industrial whales like Samsung and Tesla were waiting at the $75 floor to scoop up cheap contracts. This was a massive transfer of wealth from speculators to industrial users who saw the $9 drop as a gift, allowing them to secure inventory at a discount. This creates a staircase pattern where the floor has moved from $65 last week to $74 this week, proving the direction is still up even if the steps are getting steeper. We must also recognize the massive disconnect between paper and physical markets. While the screen showed a $9 crash, coin shops and physical dealers did not lower their prices. In fact, some dealers raised their premiums because they treat physical metal as a stable store of value while viewing the paper market as a broken casino. The window to buy physical silver at the $74 spot price was likely only open for 15 minutes. Proving this was a paper event, not a physical one. In a real bear market, physical holders panic and sell, but today they held tight because an ounce is still an ounce. Volatility is essentially a tax on leverage, and today the people trading on margin paid that tax, while physical holders gained valuable information. We now know the market is capable of hitting $83. That flash to $83 was a price discovery preview, a glimpse of where the price wants to go once suppression lifts. This move was specific to silver's internal market structure and not a macro event, meaning the boat simply tipped over because positions were too heavy on the long side. This cleanse is actually bullish for January because it resets the open interest and clears the decks for the heavy jets, the pension funds, to land. These funds are long-term thinkers who see $78 as a bargain relative to the $83 high, potentially increasing the probability of a strong January effect. However, we should expect some sideways chop between $75 and $80 for a few days, as the market digests this $9 move and allows moving averages to catch up. The long wick on the chart creates a supply overhang because traders who bought at $83 are now bag holders waiting to sell at break-even, so $83 will be a tough nut to crack in the immediate term. Despite this, the gold-to-silver ratio continues to compress, showing that silver is still outperforming gold even on a crash day. There are rumors that a bank may have been in trouble or forced to liquidate a long fund, or perhaps banks spent significant ammo in paper contracts to defend the $80 level. If they did, they only dug their hole deeper, increasing the explosive potential for the next rally. As we head into the final days of the year, liquidity will remain thin, and we could see more flashes in either direction. Your strategy should be to stay out of the crossfire by avoiding stop losses that algorithms can target. The monthly close on December 31st is the most important signal. If silver closes above $75, it will be the highest monthly close in history, signaling to trend followers that the bear market is mathematically dead, and a new secular bull market has begun. This long-term trend can last 10 to 15 years and is far more important than daily noise. We are likely seeing a seller strike from mining CEOs who refuse to sell their production into a manipulated casino, further draining the physical swamp. Even as the price dropped today, I predict we will see inventory outflows from vaults, as industrial buyers used the dip to take physical delivery. Silver is also acting as a geopolitical safe haven against year-end risks, as investors prefer metal in a vault over cash in a potentially failing bank. At $80, silver's market cap is finally large enough for mid-sized hedge funds to enter, creating a reflexivity loop where higher prices attract even bigger money. To prepare for the turn of the year, you must audit your leverage. If today's swing made you ill, you are over-leveraged, and should move toward physical metal or paid-for mining stocks where stops do not exist. The $75 line is your hard deck and a clear buying opportunity as long as it holds. Ignore the intraday noise and the weird candles caused by low volume. In the proper context, this shooting star is not a bearish reversal, but a liquidity test and a speed bump. The market tested the ceiling at $83 and the floor at $74, and it now knows the range. The wick we created is not a ceiling, it is a target that the market will likely return to fill in early January. We are on a clear path to $100 as silver regains its job as a monetary metal and strategic reserve asset. Today was meant to be scary because if it were easy, everyone would be rich. You earned your gains by enduring the volatility and holding the line. You are positioned in an asset class that offers protection from debt collapse and exposure to the energy boom. The rug pull failed to break the trend. The bull is alive, and it is angry. To understand this better, think of the silver price like a beach ball being held underwater. The bank's grip slipped for a moment, and the ball shot up to $83 before they wrestled it back down. But now we know exactly how much upward energy is stored in that ball. Alternatively, consider the market like a rising river. The banks can build a dam to pin the price down temporarily. But as the water continues to rise from industrial and monetary demand, that dam will eventually break under the pressure.